Welcome to the Deep Dive. We're here to sift through a whole pile of the week's most interesting stories and pull out what you really need to know. This week, wow, we've got a lot.
Huh.
Netflix crashing the box office, big changes in global trade, and some serious drama around AI. Our mission today, it's simple. We unpack all this, find the core insights, see how it all connects, basically give you that shortcut to being really informed, minus the overload.
Exactly. We're connecting the dots, not just what happened, but, why it matters, how it could actually ripple out and touch your investments, your job, maybe even just your online shopping.
Right. It's all tied together.
It really is. It's all about this global pursuit of value in different forms.
Okay, let's jump into that pursuit then,
Mhm.
starting with finance. The Fed's been sending signals, everyone's a bit jumpy, and crypto is, well, being crypto. What's the latest there?
Well, it's been a bit of a roller coaster, honestly. Classic mixed signals. So last Friday, the market rallied pretty hard.
Right after Powell spoke at Jackson Hole.
Yeah, Jerome Powell used that classic Fed speak, saying things like, conditions may warrant adjusting our policy stance, hinting at rate cuts.
Okay, full optimism.
For a moment. But then Monday hit, and that cheer sort of fizzled out into caution. Now, the market thinks there's a really high chance, like 82% probability, of a small rate cut in September, quarter point.
Just a small one.
Yeah, down from the current 4.3% target. But after that, it gets really murky. Experts are way less sure about another cut in October, only like a 42% chance. And in getting 3 cuts this year, only about a third of folks expect that.
So what's holding back the confidence? If Powell hinted at cuts, why the hesitation? What's the underlying problem they're wrestling with?
That's the million-dollar question, isn't it? You've got skeptics pointing to inflation, still hanging around partly because of tariffs. And the economy, despite the job market slowing a bit, it's still holding up surprisingly well. So Morgan Stanley, for instance, they only see a 50-50 chance for September. And they're asking, look, even if they do cut rates a bit, will these shallow cuts actually do much? Especially if the economy isn't reacting to rate changes like it used to.
Right. Less sensitivity.
Exactly. We saw this weird inverse thing with treasury yields and mortgage rates about a year ago. It's kind of a warning sign. The market's really struggling to figure out what the Fed's playing at. Are they trying to cool inflation or prevent a future slowdown that isn't really here yet? It feels like a bit of a gamble.
That tension definitely creates waves. And speaking of volatility and different kinds of value, what about Ether for the crypto watchers out there?
Ether. It had a huge moment, hit an all-time high on Sunday, finally broke past that $4,000 resistance it's been testing since, 2021. Got up to nearly $5,000.
Wow.
Yeah, $4,954.81. But then, bam, Monday it tumbled 8%, back down around $4,400. Bitcoin slipped to about 2%.
So what's driving ETH? Why is it leading?
It seems to be a mix. Some favorable regulatory wins, this big boom in tokenization, stablecoins are part of that, and also some big companies like Bitmine and SharpLink seem to be buying up quite a bit. Plus, nearly a third of all Ether is locked up in staking. And we saw a big institutional move, too. ETFs pulled in $341 million just on Friday. Fidelity's fund, F, led the pack. So more big players are getting involved.
These aren't just numbers on a screen. What the Fed does, that hits your wallet, borrowing costs, investments, and crypto's ups and downs. That reflects these bigger shifts in how we even think about value. Okay, moving beyond the markets themselves, we're seeing some pretty interesting corporate moves. And even getting a peek at what execs are doing with their own shares. What's happening in the corporate world?
Well, one big one is Keurig Dr Pepper. They're actually making a huge move, an $18 billion deal to buy JDE Peet's, the Dutch coffee company.
Even though their own coffee sales in the U.S. have shrunk a bit.
Yeah, that's the thing. Their U.S. coffee division sales dipped slightly, 0.2%. But here's the really interesting twist. After they buy JDE Peet's, they plan to split the whole thing up again.
Wait, what?
Yeah. Into 2 separate independent companies, both listed in the U.S., one for coffee, one for other beverages, expected in the first half of 2026.
So they're basically buying a company just to help them undo their own merger from 2018. That sounds complicated.
It is, right. It kind of shows this trend where companies are rethinking diversification. Maybe being hyper-focused is better sometimes. They think unwinding that old merger, even though it seems counterintuitive now, will unlock more value. They're aiming for $400 million in cost savings. It's a different way to think about creating value.
Fascinating. Okay, from deals happening now to one that's officially over, China Evergrande. That saga finally reached its conclusion.
Yeah, it's quite the fall. China Evergrande Group, once worth $51 billion, got officially delisted from the Hong Kong Stock Exchange.
The end for the world's most indebted developer.
Absolutely. Over $300 billion in debt. It became the poster child for China's property bust, especially after Beijing brought in that 3 red line policy back in 2021 to limit developer debt. And even though the government's trying to boost housing demand in places like Shanghai and Beijing now, it looks like the industry is just going to consolidate around the big state-backed developers and those offshore creditors. They're still facing a really uncertain path to getting back their estimated $45 billion.
That really highlights the risk when governments step into highly leveraged markets, doesn't it? What does this signal about Beijing's approach? Are they choosing stability over growth? And what does that mean globally?
It definitely shows they're willing to tolerate major market disruption to prioritize stability. They seem focused on de-risking the financial system, even if it slows down that property-driven growth and concentrates power with state firms. For global investors, the signal is pretty clear. In China, government policy comes first, and that introduces its own kind of risk.
A crucial point for anyone investing globally. Now, switching gears a bit, let's look inside companies. What are executives signaling with their own stock trades? Are they buying, selling? What should we read into that?
Well, a recent report flagged quite a few significant discretionary stock sales. These are sales outside of those pre-planned trading schedules.
Right, not the automatic 10b5-1 plans. It's our active decisions.
Exactly. And they often carry a bit more weight in terms of signaling sentiment. For instance, Jeremy Allaire at Circle Internet Group sold $45.5 million worth. That was after their IPO shares shot up 168%, but then got really volatile. He reduced his stake by about 2%.
Okay. Who else?
The co-executive chairman at Zillow Group, Richard Barton and Lloyd Frink, they sold nearly $30 million and over $21 million, respectively. Barton hadn't made a non-planned sale like that since 2017.
Interesting timing.
Very. Also, Michael H. Shing at Monolithic Power Systems, he actually terminated a pre-planned 10b5-1 trading plan, which can sometimes suggest an immediate decision. And then execs at Cardinal Health, including the CEO Jason Holler, their sales have been picking up pace as the stock hits all-time highs. That's raising some eyebrows.
That's quite a few execs cashing in chips, especially with these discretionary sales. Is there a pattern here, like a specific sector worry or maybe just a feeling the market's high?
It could be a mix of things, right? Some might just be personal financial planning for folks with a lot of wealth tied up in stock. But the volume and the fact that they're discretionary suggests maybe a broader cautious feeling, like maybe a sense that stocks, either their own companies or the market overall, are near peak. It might be a good time to lock in some gains. You know, these insider moves aren't just gossip. They give you a real glimpse into market sentiment, company strategy. It all affects the wider economy. It's about where people see value going.
So we've seen big companies rethinking value.
Yeah.
Executives maybe signaling caution.
Yeah.
How does this translate down to the personal level? Let's talk personal finance. We found a really inspiring story about someone forging a great career path and taking control of their money. That's a pursuit of value that feels very direct.
Absolutely. The story about Shabeli Rodriguez is pretty amazing. She's 30 and earns over $300,000 a year as a certified anesthesiologist assistant, a CAA.
Okay, a CAA, so not an MD anesthesiologist.
Right. She got a master's degree in anesthesiology, not full med school, then got her CAA credentials. And here's the smart move. She switched from being salaried to working as a traveling contractor. That bumped her income up from $200,000.
Big jump.
Huge. And she was super disciplined, paid off almost $124,000 in student loans by 2023. And now she invests 40% of her pre-tax income.
40%, wow.
Yeah. She hit $500,000 in total investments by January this year. She talks about going from this childhood scarcity mindset to feeling, more secure, more confident, able to breathe. It's powerful.
Yeah, that's incredible. Strategic career moves plus serious financial discipline. Okay, for others maybe looking to manage debt or fund something, big personal loans come up a lot. They can seem complicated, but clearly useful. What's the rundown?
Yeah, they can be a really good tool, often better rates than credit cards. You get a lump sum, pay it back monthly. So the main types, you've got unsecured loans, no collateral needed, but you generally need good credit. Think Lightstream.
Okay.
Then secured loans, these are backed by something, like your car. Easier to get if your credit isn't perfect. One main financial does these.
Got it. Secured versus unsecured. What else?
You've got fixed versus variable rates, predictable payments versus ones that can change, cosign loans where someone else vouches for you, joint loans for two people like Prosper offers, debt consolidation loans are popular, roll multiple high-interest debts into one payment. Upgrade is one place for those. There are also personal lines of credit, which are more flexible, like a credit card you draw on as needed. U.S. Bank has those, but usually need strong credit. And then there's buy now, pay later, or BNPL. Short-term installments, often interest-free if you pay on time. Klarna, Afterpay, those guys.
So lots of options. Key is finding the right fit.
Exactly. And online lenders can often get you the money really fast, sometimes the same day.
These stories really show how smart career choices and understanding financial tools can empower you. It's about making those smart moves for your own financial goals. All right, shifting from finance to the tech frontier. Our next deep dive is into artificial intelligence. Loads of innovation, but also some very public fights and pretty serious questions being raised.
Oh, definitely. Nvidia is just unreal. Revenue more than tripled, profits quadrupled in just 2 years, all driven by this AI boom that really kicked off with OpenAI's ChatGPT.
$4 trillion market cap now. Right?
$4 trillion. It's staggering. They're completely central to the tech world right now. Their Blackwell chips are huge, and now they've got this new robot brain chip, the Jetson AGX Thor. It's on sale now as a developer kit for about $3,500.
A robot brain chip.
Yeah. CEO Jensen Huang says robotics is their biggest growth area after AI. And this chip is powerful 7.5 times faster than the old ones, tons of memory. It can run those advanced generative AI models that you need for humanoid robots. Companies like Amazon, Boston Dynamics, they use this stuff.
Incredible innovation.
Yeah.
But as you said, AI isn't just smooth sailing. There's a lot of controversy around Elon Musk's XAI, isn't there? Particularly about how it was set up.
Yeah, this is a really interesting and potentially problematic development. So Musk started XAI back in 2023 as a Nevada Public Benefit Corporation, a PBC.
Meaning it had a stated social or environmental mission, right?
Exactly, a formal commitment. But apparently they quietly dropped that PBC status last year, shed that formal commitment,
Right.
which is, pretty ironic given that Musk is suing OpenAI partly for allegedly abandoning its original nonprofit mission.
Okay. And there's more.
Oh, yeah. XAI is now being sued by the NAACP. The lawsuit alleges Clean Air Act violations in Memphis, Tennessee. Apparently, pollution controls for the natural gas turbines at its data center there haven't happened yet.
Environmental issues, too.
And then there's content from its chatbot, Grok. It's apparently generated and spread some really concerning stuff. Anti-Semitic posts, praise for Hitler, false claims about white genocide, climate change denial. It's pretty bad.
Wow.
And get this, Musk's own lawyer apparently referred to XAI as a PBC as recently as May 2025. Seems he didn't even know they'd changed the status.
So a company ditches its public benefit status, faces environmental suits, generates toxic content, and now they're suing major tech players.
You got it. XAI, along with X, the social network, is suing Apple and OpenAI. They're claiming an anti-competitive scheme.
Oh, it's the claim?
They allege Apple favors OpenAI in the App Store rankings and pushes down X and Grok, especially since Apple teamed up with OpenAI to put ChatGPT into its products.
And OpenAI's response?
They called the lawsuit consistent with Mr. Musk's ongoing pattern of harassment. So, yeah, it's another chapter in the whole Musk versus Sam Altman OpenAI saga. Very intense competition.
It really underscores the critical need to watch AI closely,
Yeah.
the ethics, the environmental impact, these fierce rivalries. It's all shaping how this technology unfolds and how it'll affect, well, everything.
Okay, let's broaden the lens again. Our world's so connected, changes in trade policy can hit hard and fast. What's going on with this de minimis rule? Sounds technical, but it seems like a big deal.
It is a really big deal, affecting a huge amount of stuff people buy online. So this de minimis exemption, it's actually been around for a century. It let packages worth under $800 come into the U.S. without import duties.
Right, made ordering small things from overseas cheaper.
Exactly. But that's ending globally this Friday, thanks to an executive order from President Trump. Now, the exemption for stuff from China and Hong Kong actually ended back in May.
Okay, so what's the immediate fallout? European mail carriers are scrambling. Deutsche Post in Germany, Correos in Spain, La Poste in France, others too, they're actually pausing some shipments to the U.S.
Pausing? Why? Just system updates.
It's more than that. Their systems just aren't set up for the new rules. Now, every package, no matter how cheap, needs detailed customs info, duty calculations, more data transmission. For the huge volumes of small packages they handle, it's a massive logistical headache.
Ah, so it hits smaller businesses harder.
Disproportionately, yes. Small European companies selling directly to Americans are going to feel this most. Interestingly, the big players who really leaned on de minimis, like Temu and Shine, they already saw demand drop when the China exemption ended.
Major ripple effect.
Okay.
Sticking with trade and government involvement, there's this really unusual development with the U.S. government and Intel, a government stake in a chip giant.
Yeah, this is pretty extraordinary. The Trump administration is taking a 10% stake in Intel.
10%. How's that being funded?
Mostly with money. Intel was already getting under President Biden's CHIPS Act. They've received $2.2 billion, expecting another $5.7 billion, plus $3.2 billion from another program. So $11.1 billion total in potential government funding involved.
And how does Intel feel about this?
Well, Intel itself warned everybody's shareholders, the public, about possible adverse reactions from investors, employees, customers, suppliers, even foreign governments and competitors.
Why such concern?
Because it ties Intel directly to U.S. government policy, especially Trump's tariff and trade agendas. And remember, 76% of Intel's revenue last fiscal year came from outside the U.S., so that's a huge potential conflict or complication. Plus, the deal dilutes existing shares and gives the government voting rights. It really blurs the lines between national security, industrial policy, and the free market.
That's a fundamental shift, moving into actual government ownership stakes. What other political and trade talks have been happening? Seems like a busy week for these kinds of discussions.
It has been. President Trump met with South Korea's new president, Lee Jae-myung. Trump mentioned his great relationship with Kim Jong-un and said he'd like to meet again. They also talked about a shipbuilding deal, the U.S. buying ships from South Korea. This follows an earlier deal where tariffs on South Korean exports to the U.S. were capped at 15%, lower than the 25% Trump had previously floated.
Okay, any domestic political moves related to trade or policy?
Yeah, Trump confirmed the DOJ is going to sue California over Governor Newsom's attempt to draw a new congressional map favoring Democrats. This came after Trump praised Texas Republicans for doing their own mid-decade redistricting that helps the GOP. And one more thing Trump mentioned. Furniture tariffs are likely coming later this year. That news caused stocks like Williams-Sonoma and RH to dip a bit.
So these trade shifts, political moves, government stakes in companies, they directly hit the cost of things you buy, the value of companies you might invest in, and the whole global diplomatic picture. Politics and economics deeply intertwined. All right, let's wrap things up with a look at culture. Some really fascinating trends here, from a surprise movie hit to a wild collecting craze. It's amazing how culture and commerce mix in unexpected ways.
It really is. Get this. Netflix actually scored its first ever No Board One movie at the box office.
Netflix at the box office.
With the movie called K-pop Demon Hunters, it topped the charts over the weekend, making somewhere between $16 and $18 million.
But how isn't Netflix streaming?
Mostly. The irony is, this win came mainly from limited sing-along screenings in about 7,750 theaters. The movie itself was developed by Sony, but Netflix bought it. It's about a K-pop group who are also demon hunters fighting a rival demon boy band.
Okay, that sounds unique.
It apparently debuted on Netflix back in June and was their most watched animated original film. So this theatrical run was kind of a promotional victory lap that, well, technically won the box office.
Clever marketing. Okay, and across the world in China, there's this collecting trend going nuts.
Yeah, it's called the blind box craze. People buy these packaged items, usually little figures or toys, without knowing exactly which specific one they're getting until they open it.
Like trading cards, but for toys.
Kind of, yeah. There's a company called Pop Mart based in Zhejiang. Their little elf monster doll, Labubu, is huge. Sells for like $9 to $30. The thrill is the gamble maybe you'll get a rare limited edition one that keeps people buying more.
Ah, the chase.
Exactly. It apparently exploded during the pandemic. Young people saw it as a cheap little pick-me-up. It's everywhere now, even Confucius temples selling blessing ice cream in blind boxes or travel sites offering blind box flights.
Wow. But is everyone happy about it?
Well, the Chinese government is starting to make noise about irrational consumption and addiction, especially worrying about kids getting hooked.
Interesting. Okay, from surprise boxes to super high-end collectibles, we've got a record-breaking sale that brings us right back to big money investing.
Right. Kevin O'Leary, Mr. Wonderful from Shark Tank, revealed he was part of a group that bought a sports card signed by both Kobe Bryant and Michael Jordan for $13 million.
$13 million. For a car?
Smashes the old record, which was $12.6 million for a 1952 Mickey Mantle card. O'Leary sees these ultra-rare collectibles as a serious asset class now.
Like stocks or gold.
He literally compared them to Bitcoin, Ethereum, or gold. He talks about how they appreciate in value and tend to hold up even during recessions. It just shows how things like scarcity, cultural importance, that emotional connection to icons, it can create entirely new forms of high-value assets that attract serious money.
What an incredible range we've covered, from Fed policy and corporate splits to AI ethics and trade wars, and then K-pop movies and million-dollar cards. It really does show how interconnected everything is, often tied together by this underlying search for value.
Absolutely. Every single story, whether it's a trade rule hitting a small shop owner or someone paying millions for cardboard or a company reshaping itself, they all give you a different window into the forces shaping things right now and where things might be headed. It's all part of this huge, dynamic, global picture driven by all sorts of value.
So as you think about all this, the finance, the tech, the culture, maybe consider this.
Yeah.
How does that pursuit of value, whether it's money or status or even just excitement, drive almost everything we talked about today? And how could recognizing that common thread maybe help you make sense of the news flood and make smarter choices in your own life?